Hey DC, how are you doing?
Hi, Alan. Pretty good. Yourself?
Doing well, thank you.
Very great.
Okay, people coming in. Hey, hey Avanti. Hey Ann.
Hey, Alan,
I
how are
also see doing well. How about you?
you? Good.
Good. Nate, good to see you.
Hello, sir.
Great, good. Okay, give a few minutes for people to come in. This one's probably more Viasat, like um, helpful, but people had a number of questions of how to adjust their contributions, Roth versus, am I maxing out my contributions? So um, I was like, let's do something quick. And I put a note that if you bonus checks, you have to go and change the allotment, since it just is this, for us, it's the same for all of our compensation. Um, it's unfortunate. I think I wish they had better selections, but I wanted to do this quickly because those are supposed to come here soon, and so if people want to make adjustments, if they want their bonus money for something else, they can. Let's see. I'll go share. Okay, for people that are with Viasat, or if you have Empower as your log into Empower, so that you can, as we're walking, I've got a bunch of screenshots on here, but you can walk through and do these, real time if you're, if you have any questions. Additionally, if you have your tax return, grab that, because we're going to talk. People ask like Roth versus traditional, and it really is that's not something. It's not advice I give. I don't give advice here. This is educational, but it really depends on your tax bracket and where you're at. So I was going to show, get your get your tax return, show what your taxable income is, and then we'll go through tax brackets, historical tax brackets, and that hopefully help you make a more informed decision on what portion you want, traditional versus Roth, etc. And okay, I'll just give it one more minute, because let me check with, I'm going to see if, because I know Dustin, he was, somebody just slacked me that they're going to join a bit late. Okay. And let me just check with one other person. Okay. Well, I'll get started. Okay. Okay. Hey, Sandra, just saw you. Samantha and Chanson, Katie, good to see you guys. How's everybody doing?
Hi, Alan. Good to see you.
Likewise.
Thanks for the invitation. Super excited for this.
And this one tends to be a lot of, usually they're not as just as Viasat specific, but there were several questions that popped up. And I was like, okay, we got to do this quickly because and a lot of it is more specific to Empower, our 401k custodian, how to make adjustments there. But then it will go into Roth versus traditional, a couple other things about company stock, that's I think hopefully going to be valuable for everybody. But it's got the disclaimer up. As mentioned, this is not advice or recommendations, but educational, and hopefully you guys find these valuable. But it's you really need to have your own financial advisor, preferably fiduciary, tax professional, attorney for specific recommendations. So I see several people coming on. So does everybody, do you agree? Can you give me a thumbs up that all of you agree to allow me to post this recording? And I'll post the slide deck up as well. But it's just for free, so I'm not paying anybody. Okay, cool. Thanks, Wesley, Mike, Dustin, Sandra, Chanson. Yep, thank you. Okay, DC, good. Nate, C, okay. Okay, I think that's got everybody. And okay, real quick, if you have a minute, here's the agenda. But if you are advised that, or you just have Empowers, log in so that you can do some of this stuff real time as we're walking through it. And then if you have your tax return, pull that out too, because we're going to talk about taxable income, AGI a little bit, and then that goes into the kind of the Roth versus traditional discussion, because we'll look at, you can see where you're at, and then I'll have the tax brackets for 2025, so that you can see where you land, and what makes sense. Do you go traditional? Do you go Roth? Do you go combination, et cetera? So any questions to start? I'm not doing a poll today, but I thought I'd give you guys a minute if you wanted to grab log in or grab those items, but we can get started. Okay, the first, if you go on the Empower page, this is kind of what pulls up initially. And I've obviously blanked out, some of the other stuff, but they do have a net worth tool where you can, include all your other accounts and stuff like that. Kind of, it's kind of interesting, but you want to connect all your accounts to that as well. It's a security issue. But once you're after the starting page, you really want to go to now we're talking about for adjusting contributions, because for us, if we have a bonus check coming, I think the whole company's getting some, they're probably smaller, but getting some kind of bonus. Your contributions go towards all your compensation. So if you have, let's say you had 10%, which is what we need as a minimum match, they're gonna, that bonus check is gonna take out 10% as well. So if you have other uses for your bonus money, then you want to go in and adjust your contributions immediately. Hopefully it's not too late, but adjust those contributions down if you want to take home more of your, and then go back in after you get that bonus check and readjust your contributions up again. But this is where you go under account, you see it kind of drop down, Viasat 401k, and then you go click on the contributions page. That'll get you here, which there's a couple of ways you can adjust it. Right here, I used an example of 11% so that you can see, no matter what, if you do, once you do 10%, you get the max 5% match. And you can use this roller here or just change it right there. Once you're done with that, you've got the percentage that you want. Then you go to continue, and you determine what percentage you want, traditional versus Roth. And you just put the value in here and it'll automatically update the other one. And but you can obviously do just pre-tax, Roth, or split the combination, which I think for most people, might be a split. In general, as people are young and their salaries are only going to increase, I'm all about, while you're in the low tax bracket, max out that Roth stuff right away. Get that tax-free growth bucket moving, and as your income rises over time and you get into the higher tax bracket, then that's when you might take, hey, let's defer these taxes for right now, and then potentially do Roth conversions down the road when you're in between retirement and when you have to take required minimum distributions and Social Security before you take Social Security as well, because that's additional income. But so the best time to do Roth conversions is once you stop working, before you've started Social Security, and before obviously you have to take required minimum distributions on that, all that pre-tax 401ks, IRAs, TSP, etc. Any questions here about the adjusting your contributions? Okay,
Alan,
yeah.
if you increase your percentage up to the max and it surpasses the max, what's going to happen? Let's say the max is at 20% and you accidentally put like 21% or something.
Okay, so and what's your I want to make sure I get this right, because you can contribute a larger percentage. I think I have to check. I think you could probably contribute almost like a lot of places like this, like 50% if you wanted to. But you're talking about when you max out your annual contribution, right?
Yes.
So, yes. Okay. We'll get to that. What happens though is the company, it just stops. So your paycheck will be larger, because once you max out the contribution for the year, it won't allow you to contribute. The challenge for people is if they change jobs, and this happens to people in the military. Say I know some people that they maxed out their TSP because they knew they were retiring or getting out that year, but then they started working somewhere else in the the fourth quarter, and they start contributing to that 401k. You can't do that if you've already maxed out, but the company doesn't know that. So they will not stop. They'll let you over contribute, and you've got to go and take money back. You've got to go fill out some forms and do that to get money back. But I'll show you, Dustin, in a couple of slides where that is. Okay, once you hit continue there, it shows, yep, here's this, and this is how you do auto increase. If you want to add, like you can, I'll have another slide on that. But you can select it to auto increase and percentage. Here's that auto increase. Where you can go how much percent you want per year until it reaches whatever percent contribution, and then what date you want to start it at. So that's a cool feature if you're not already able to max out your contributions, but hopefully everybody's at least getting the 10% match total. So additionally, if you drop your, let's go back here. If you drop your contribution amount, like I went down personally, I have other uses for that bonus money right now with doing remodels. So I went down to 1%, changed my contribution. That's why you actually see this is actually reality. That's what I've got right now. And then I'll go back and adjust it. But you need to adjust it above 10% because the 401k match is for all of your compensation, which is your bonus as well. So if you want to get the entire match, if you average out throughout the year at least 10%, you'll get the full match. And just like you're saying, Dustin, let's say you had 21% and you max out in late November, your total contribution. And so you're not contributing that 10% through December, right? Or that 20%, the 10% for the match. It doesn't matter. If you average throughout from for our fiscal year, which starts April 1st through March 31st, if all the contributions average 10%, you'll get the full match. Okay, what questions? That was a lot of mouthful. Yes. I don't think I explained that too well. Wesley.
Yeah, so I think I
And
understand.
if you guys could come on video, that'd be great. It's easier for me to see if people are bored or interested, or if I need to go into more details by seeing your face.
So I think I understood that you're saying the employer match
Yep.
doesn't care about individual, like each time you contribute, it only is an average throughout the year.
Correct.
And there's a cap on it.
So the cap is the maximum. Here you go. Let's go back. Right here, the maximum at Viasat, our match is 50 cents on the dollar up to a maximum of 5% match, right? So you have to contribute 10% averaged across the year of everything to get that max 5% match, right? But that match includes your bonus. So let's say you have $10,000 bonus. So what's 5% of that? 500 bucks. So to get that match, you have to, even if you dropped it, but if you dropped it down so that you get most of your bonus, like I just said, I dropped it down to 1% because I want to use that money for something else. I need to go above 10% for the rest of the time to make sure I get that full match. Make sense? So I'll take a little more haircut on the paycheck and contribute more of that to the 401k, but I keep my bonus.
Yeah. So yeah, if you do that, it's fine, you still get the maximum if you did 1% on the.
Yep,
bonus
I did
1%.
Higher on the
rest of them.
Exactly. I do 1%, and I'll go back. I go back over. I try to, like Dustin was saying, I actually prefer, and not every company is like this, where they allow that average. Like the military's like that. You have to contribute every paycheck, or you don't get the match, which is jacked up in my opinion. But whatever. I'm not the one that wrote their 401k plans. But ours isn't like that. You average it, cross, you're good to go. And then let's see. So I'll go back to where we were at. Actually, I'm going to show you, Dustin. I'm going to go right to this. Okay, Dustin, this is the slide where you're talking about maxing out your contributions. So if you're on account and click on account overview, you can see what your balance is. Sorry, I'm hiding mine. Your rate of return, and then what your contributions are. And you can see, for me, this is what I was doing. And then look at, all of a sudden it looks kind of flatlined, right? Because right now I'm at 1%. So if I'd stayed there, that's all I would contribute for the entire year. The year I've got catch-up contributions. The year you turn 50, you get an additional $7,500. So if you notice right here shows your contributions. Here shows what you're estimated on track to contribute, which once we get the bonus check, I'm going to bust this back up and it's going to go back to 31,000 because I'll max it out. But it shows your IRS limit and then a staircase showing where you're going to end, estimated at the year end based on your current contribution rate. Questions?
And if you hit plus or minus, it'll tell you, what your max is going to be. It will increase that
this.
Right, yeah, that dollar.
Yep. It knows your age. You know what I mean? Because the employer knows your age, so it does that automatically. That once the year you turn 50, not when you're 50, the year you turn 50, you can, because say you're born, your birthday is December 31st. You can still contribute that catch-up contributions. Katie, I'll get your and just ask questions. The chat is I can't monitor it as well because I'm I can't multitask, I guess, which none of us can. But it knows automatically, and it'll add that additional amount that you can contribute, and you get the match on that too at Viasat. The IRS limit, so it's not based on age, but there's catch-up contributions for various things, Katie, that like, so that, like I said, the year you turn 50, you can start contributing. Even if your birthday is December 31st, January 1st, before that, when you're 49, you can start contributing that catch-up because it's just that year, you know. Then there's actually, they recently upped it for people that are 60 to 63. It's like 11,250 or something. So it's even higher catch-up contributions than this current 75. This year, 2025, the salary deferral max is 23,500. That's for everybody, regardless of age. And then if you're getting older, they allow additional tax advantaged contributions like the 7,500 or the 11,000. There's additional, same thing for your individual retirement account, your IRA. It's a much smaller number, but the year you turn 50, you get an extra $1,000 right now, and that they finally changed. That's going to be adjusted for inflation, so that catch up hopefully will get even larger. So, and the annual limit for an IRA this year is 7,000. So 7,000 plus the 1,000. Katie, you got your hand up. You got a question?
Yeah. Does the IRS limit, does that include their match, or
No,
is that
okay.
completely separate?
Perfect, because that's what my next thing was going to go into. I wish I get that slide. I might have to go find it. So under the umbrella of the 401k, which is like 412, Avanti, you could probably correct me on, like the IRS actual, where it's written, it's $70,000 this year. So that 23,500 is only salary deferral of yours. Then the match, then if the company has profit sharing, what have you, all that goes up to a maximum of 70,000 plus catch-up contributions. So that's for people under 50. The year you turn 50, that catch-up, so that they could contribute 77,500. So if you're able to do that, and that's the whole mega backdoor Roth that I've talked about before. And they were supposed to get it this year. I hit up benefits again. It sounds like Empower's just having trouble with the back end, and it likely will be in 2026 that we get it. But what the mega backdoor Roth, what that allows is you can, I'll go back here. Sorry, go back to some of these other things. So it needs two things. The plan has to allow for after-tax contributions. So you already taxed on the money. It's not like the traditional, 401k deferral, but you could max out that 23,500 however you want to do. But then if the plan's set up correctly, you can do after-tax contributions. It's paid tax. It's not exactly Roth money yet, nor traditional, but you've already paid taxes. But then the plan also has the second part of that, in-service distributions. That money can all be turned into Roth dollars. And so, and some companies like that have Fidelity as their custodian, they can set it up to where it immediately becomes Roth dollars. You've already paid taxes, so of course you want the gains on those dollars to be tax-free. You want them to be Roth. But the in-service distribution allows you to either convert that money that's it's not traditional, it's not Roth, but roll it it becomes part of your Roth 401k, or you could roll it out into your Roth IRA, and it grows that way. Does that make sense? Okay, because it's a great thing. And so if you have the money additional, it's a great, way to, grant you can't use that money typically, until 59 and a half or rule of 55. You can use your employer money if you retire early. 401k, if you retire from the year you're turned 55 and onward, you can start using that money penalty free. But it's tax-free growth. Like, that's amazing amount. Think of $7,000 a Roth IRA with that $70,000 limit. Even with, after your salary deferral and your match, you're probably sitting on $30,000, a little more, $30,000 to $35,000 of additional money that you could invest if the plan's set up right to allow that. And we'll have that in 2026. So that was something we've been pushing for a while. What other questions you guys have on this? Because I know
Okay, back to contributions.
yep.
Let's say the max percentage contribution is 20%.
Okay.
Is it better to do like 15% on Roth and 5% on traditional?
We'll go. Okay, Dustin, grab your. Did you get your tax return?
I did. I don't know where it is
Okay,
right now.
so we'll get into that. Let me. That's a slide further down. So let me just go through these real quick of also how to change your investments. Same location under account under Viasat profit sharing. Then you go down to your investments. It shows you what you currently are invested in, and you can see what current is, what the future is. If you've adjusted those, you can change those. But then you click on change my investments, and it'll allow you to go to this next slide where how do you want to change your investments? Do you want them to do it? They charge, Empower charges like 0.6% fee. So like every quarter they take out 0.6 of your account. To me, I just do it myself because and I think we talked about this before. Like, hey, you could do it if you weren't comfortable with selecting a set of diversified, you could maybe go let them do it for you, see what they invested in, and then you could get out of it and just invest it yourself.
That's a good question. How do you get out of it? Because I'm in it and I can't find anywhere to get out of it.
Call them if they can. So I'd call them right away. Yep, and they're open till I think 8 p.m. Pacific time. So yeah, call them and fix that.
All right.
Okay. Because yeah, you don't want to, like, to me, that's why I point that out. It used to be 0.75, I believe. They dropped it a little bit, but it's still you can do it yourself and do it well. So click on the do it yourself. You go here, you can rebalance your investments right now, or typically changing your future investments is what but it rebalancing. So like when you get the match is all in Viasat stock. If you don't want that much stock, you basically adjust your proportions here. So here's all your current allocation, and then you can adjust those. Or wait, I've only got these funds. Let me see all funds, and you can look at there's a number of them. The certain things I look at are expense ratio, which you click on this, you'll see. But here's something else. You can look at performance on these various, all the different funds, and click through all the different funds they have. It shows 1 year, 5 year, and 10 year, or since inception. How those different those have performed historically. And then here's this is what I pulled up, because you can look at net. That's something that's what index funds have changed. Mutual funds used to be super expensive. We're buying freaking these mutual fund owners their yachts instead of our yachts, with these ridiculous. They used to be like 1.5 to 2% expense ratios that they're taking your money away. It's just disgusting. But you can look at all these and go and see what are all these, the expense ratios. See, like this emerging markets, 1.34%. That's freaking high. You want, in general, an expense ratio, preferably 0.25% or less. There's actually some good dimensional funds, not in our thing, but dimensional is very good as well. And they're Fidelity, Vanguard, Schwab, they all have ones that are 0.05%, or even Fidelity has some 0% expense ratios. But at least if it's 0.25 or lower, it's insignificant, and they might have some funds that are worth having it near 0.25. Getting that, say, small cap value, or some specific section that that you want as part of your overall portfolio. Okay, so and any more questions on this about your contributions, where you can see it, and like I said, just I shifted it just for the bonus to get, and now I'm just contributing 1% Roth right now when that bonus comes in, and then I'll shift it back to a much higher contribution percentage, and I do a split between Roth and traditional. But we'll get into that. Okay.
Hey,
So,
Alan,
yep.
do you know if that bonus check is going to be a separate check or is it going to be combined with your
With your
regular?
paycheck, I think it.
Yeah.
Well, looking at the letter, it looks like it's part of the paycheck. I thought it was going to be like July 1st to be separate, but it looks like it's going to be come in together.
Yeah. Okay.
So and if you're yeah. So what that means, and it does, even regardless if it does or not, you're probably that same percentage. If you adjusted the percentage just for the bonus, it's going to impact this coming paycheck.
Mm-hmm.
Makes sense. And that's why
Yeah.
as soon as you see the money come in, go back and readjust so that you don't miss other paychecks of getting
Yeah.
them. Okay.
What happened if you don't adjust it?
If you don't, okay, let's say, Dustin, if I just kept it at 1%, all of a sudden I'm only going to contribute 1% of my paycheck from here on out to the 401k. I don't want that. I want to get the match.
I know, I know that part.
Okay,
But
okay.
why do you need to lower it? That's what I'm
Okay,
asking.
so a lot of other companies, their 401k plan has different. It says, okay, from your paycheck, how much do you want to contribute? If you have a bonus or other special pays or what have you, what percentage do you want to contribute? We don't have that luxury. It's just 1%. It's just the percentage you contribute, and that goes to all your compensation, bonus and paychecks. Make sense?
Okay.
Okay.
So it's per paycheck. Your contribution is per paycheck. Okay.
Yep. And okay, so Roth versus traditional. Okay, so here's the tax. This is the 1040. I hope you guys have your tax return. This line 15 is what matters here on your taxable income, which determines what bracket you're in. Because what marginal tax bracket you're in, and like this is for 2024. Okay, if there's raises, what have you, you can figure out, okay, I'm going to have this much additional likely taxable income for next year, and then wait, here's our tax rates. So you can go in. I just did single and married filing joint. Maybe a few people are head of household, but just for space. So you can go in and go, wait a second, where is where's line 15 in terms of these brackets? And if you hit into the 32%, but not too far into this, maybe you want to use some traditional because what traditional will do is drop down that it's going to lower your AGI, adjusted gross income, which then lowers your taxable income. That's why you're deferring those taxes right now. So if you're in the 32 or 35%, but if you can contribute some traditional to drop down to the 24, that's 8%. Like that, the 24% tax bracket is freaking huge. I mean, look at how much it spans. You know what I mean? It's pretty large, and that's only 2% difference in the 22. And here, this is our historical tax rates. This is the blue is the top marginal tax rate, and the green's the lowest. You look at the top, it's pretty freaking low compared to historical. And with our debt, who knows? I'm not a fortune teller. I don't know what taxes are, but I think they're going to go up down the road. And with the Tax Cuts and Jobs Act and whatever, the big, beautiful bill, they're trying to keep those Tax Cuts and Jobs Act numbers the same, but we'll see. Downrange, they have to collect. We have to collect taxes. So I think we're forced, going to be forced into higher tax rates. So take advantage of it now and get some of that Roth money going at a lower, like I said, if you're in a relatively lower tax bracket, and I think that 24 is a huge it's just such a large, you know, category if you're up in there that, and that's only 2% difference. Let's see. Okay, what else? Okay. Oh, here's also, this shows the other tax brackets as well. Like I was talking about historical, showing corporate versus, you know, capital gains, you know, and dividends that are treated like normal income for much of the time, much of this historical. Okay, so this is also the California tax brackets. So that goes into, you know, that as well. But really the federal is the more significant one as far as, you know, determining Roth versus traditional. And that's where you can, Dustin, you could do, like I said, you can do a percentage like, ooh, I'm in the 30, say you're in the 32. Like, well, what if I contributed 5,000 pre-tax, that'll drop me back into, you know, the 24%, then I would do that. I don't want to spend an additional 8% plus California taxes plus whatever. If I can drop it down to 8 and then later on convert it if I want to, or, you know, have, you know, or not worry about it. Maybe in the future, you know, like for a lot of people in retirement, their tax bracket's going to be lower until they lose control with RMDs if they didn't play it smart. So, okay, speaking of Tax Cuts and Jobs Act, this is that 2024 or did I get 20? Maybe it is. Okay, yeah. So the tax brackets are the same. This actually is 2024. I just didn't redo all the numbers, but look at the difference. So this Tax Cuts and Jobs Act is supposed to sunset December 31st. They're trying to keep much of it, and the tax rates the same, brackets the same. There's also a potential, and I'll let you guys know if I find out if this comes to fruition. But because they also want the tax revenue, they're still trying to keep, you know, these lower tax brackets. There's a potential they might allow Roth conversions at 10 to 15%, which is huge. So if you had a bunch of, you know, if that comes into the case and you can convert a lot at the 10 to 15% tax bracket, I think it's a good thing to take advantage of for a lot of people because you're probably never gonna, you know, that's very low. But I mean, look at the difference here. You know, like you've got 10, 12, 22, all of these are larger after 10, then 15%, then 25. So each marginal step is that much larger of an increase. So that's where I say, hey, pretty historically low. Nobody likes paying taxes, but you got to look at it as a lifetime tax management, not just this year, which too many people, and that's what most CPAs think of, because they're looking, what do they think every client wants? They think you want to pay this few of taxes this year. So that's what they typically do. But if you're smart about it, you might pay more taxes this year because in the long term, you could save hundreds of thousands of dollars in taxes by being smart. Questions? Okay. Here's capital gains tax rates. So those are when you're, you know, selling securities, selling equities. These are the different rates that you have, and this is kind of cool. Like if you say you took a sabbatical year or you retire and you don't have any real income in, you can do tax capital gains harvesting. So let's say you had up to, you know, you could, if you didn't have any income coming in, you could sell up to $47,000 of gain in some stock. So you had NVIDIA or whatever, and it blew up. You could sell that and then immediately buy it at a higher cost basis and not pay any taxes. So capital gains harvesting is something that's unfortunately not taken advantage of. And I wish I knew that even when I was much younger, you know, like in a, you know, especially in the military too, where so much income's not taxed. You know, could have sold and rebought, you know, and then you keep increasing your cost basis. So instead of say you bought something for $10, it's up to 100. You have to pay gains capital gains taxes on that $90 increase. But if you sold it and you're in this 0% and then rebought it at 100, now your cost basis is $100. And there's no law against this. There's laws against selling things for losses and then rebuying back within 30 days. That's not allowed, and the IRS will ding you. You'll have to pay taxes on that. But this, you've taken the gain. You've realized the gain. You just don't have any income, so because how the tax system set up, you don't have to pay tax on it. You rebuy that money, that same stock or whatever. Now your cost basis is $100. So it has to go to get to another $90 of capital gains. It's got to go up to $190. You know, that's that big stock we were just talking about. Okay, questions?
Why would you want to buy it at a higher price though?
That
Like you wouldn't get as many shares.
it doesn't. So no, the whole point is, let's say you buy. Let's take an ETF. This is all about capital gains. It's all about tax management. So you're because what you're doing, if you're in a low, if you retired or you didn't have any income for a year, did a sabbatical, you could sell that stuff, sell that ETF that you've had a big gain on. You don't pay any taxes, but then rebuy it, and it's at a higher price, but it's still the same amount of money. But now you won't pay taxes because that has to go way up again for you to pay any taxes down range when you want to sell it and use it. Did that answer your question?
Yeah.
Okay, because it's a really cool strategy if you're in ability. I do this too with, like, I sold some Viasat stock for a loss. And I sold some other things that I had for the exact same gain, because to get to even those out to zero, so I paid zero taxes. I took a loss here, gain here, and then I don't pay any taxes because net is zero gain. That's another strategy that you could use when you need. Okay, any questions there?
Maybe a silly question. Do we have to do capital gains inside of our retirement account, or is that completely separate?
No. So okay, nope. No, that's a good question, Katie. So your retirement account, your 401k or your IRA, that's either traditional, meaning pre-tax, and the tax deferred, and you will pay taxes as income when you pull that money out as income tax, not capital gains. With Roth money, you've already paid taxes, so that money grows tax-free forever. So when you pull that money out, you don't pay any taxes. That's why you want that balance between, you want tax diversification. You want some tax deferred, some tax-free, and then some brokerage account, where the brokerage account, that's where your capital gain comes in.
Okay.
So this isn't a retirement account. It's just you open up, wherever, Schwab, Fidelity, Vanguard, a brokerage account, and you buy some stocks that in NVIDIA, as we were talking about. Granted, I'm not a promoter of individual stock. If you want to play with 5% of your money, go for it. But otherwise, just have a good diversified global portfolio of low cost ETFs. Okay. And that was not a recommendation or advice.
Okay, yeah, I just want to make sure, because I mean, obviously, like you were saying before about the Viasat stock, that automatically comes into our 401k.
Yes, and that's separate though. That's something we'll get into, because I'll get into that, Katie, because there's something called net unrealized appreciation for a company stock inside a 401k. It's probably we'll get to it here shortly.
Thanks.
But so overall, people, I remember talking to somebody before when I put this stuff in the Slack channel. They're like, wait, I spend my money on, I don't max out the 10%, but I get ESPP, and I'm like, okay, let's go. Here's my opinion. One, you need F's cash minimum. Like some people, it's scary. Chance that I know you remember those stats. Like, 60% of the Americans can't come up with $1,000 in an emergency. Yeah, exactly. Katie's shaking her head. But get the match. That's free money, and it's a lot of money. I have that slide that where I show you know, because all of us have found like $20 or something in a pocket, or, you know, like, wow, that's cool. But people are throwing away thousands of dollars by not freaking saving, contributing 10%. To do it, get that max match, because that's free money. It's huge. Okay, and then other things like, yeah, if you got credit cards, pay that off. But then emergency fund, I typically, depends on your situation, married, dual income, blah blah blah. I like 6 months, and then as you get closer to retirement, I actually like I like more money in just to avoid sequence of return risks, more cash equivalents. So if the market just tanked right when you retired, or soon before you did, you don't have to sell that stuff. You can allow time for it to grow back. ESPP, employee stock purchase plan. Ours has a 15% gain, you know, off the lowest price of the 2 days. So ours starts, they changed it, some reason about the UK, but so February 1st, July 31st, whatever the closing stock price is that day, whichever one's lower, they take a haircut off of that by 15%, and that's what we buy. The cool thing about that though is, and why I put that above your IRA. Actually, I should put the HSA above, because HSA is huge, and that comes out of your paycheck. You can't front load it, but you could sell that money and then fund your IRA if you needed to. You know what I mean? So that's why I had it ahead of the IRA. But then hyper accumulating wealth, you know, taxable, like I said, that's taxable brokerage account. That's where you're going to pay capital gains. And that's where you typically just want equities in there, vice bonds, because bonds interest you pay income tax on. So I put my bond money that earns interest in, I keep those in my retirement accounts if I can, you know, like, and then just to, as much as you can, avoid paying extra taxes. So, okay, any questions here? Okay. Oh, yeah, I put just Liz, you probably, the military tax advantage is crazy. You don't even realize, we don't even realize it, but especially living in like California, the housing allowance that's tax free is, you know, look at this. It's like 40% of their paycheck is free, tax free. So they should definitely be Rothing it up while you're in the military. Okay, so this, you probably can't read that, and I just took a quick clip, but it's more for a reminder. Okay, so if you have company stock, like I said, I wouldn't want more than 5-10% in company stock. Yes, that's what billionaires of, you know, Amazon, etc. That's where they got their money. But they were the owners of something that went crazy. In general, I don't want more than max of 10% of my net worth in company stock. And a couple of reasons. One, people tend to be more bullish about their company, unrealistically bullish. And so they think it's always going to go up. We've seen that's not the case, sadly. But if you're going to sell company stock, the company stock to sell is the ESPP, the employee stock purchase plan, or the RSUs, ahead of the stuff in your 401k, because of this thing called net unrealized appreciation. So what you can do is when you can take all the company stock and you can roll everything else that's not company stock from a 401k into an IRA down the road. But you can take all the company stock, and you have to do it like all within a year and the entire amount. But you can roll that into a brokerage account, and then you sell it, and you're only selling it on you're selling on the amount that you got from, let's say you got a total, you have $50,000 of company stock. That's how it came to you. That you're going to pay income tax on, because that was, you know, that was income. But let's say that stock went from 50,000 to 300,000. Or actually, let's do easier numbers. Let's go from 50,000, it went up to 150,000. You roll that $150,000 of company stock into a brokerage account. That 100K of gain will only be taxed at capital gains rates, vice income, regular income tax rates. If you roll that money with the rest of it into an IRA, now you're going to pay regular income tax on all that company stock. So it's kind of tricky. You got to, this probably might be beyond the scope of of this, but hopefully it makes sense. I mean, it's a good strategy to use, but you got to be smart, and you got to know all the rules when, so it takes definite planning ahead of time. Anybody have any questions on that? Quiet group. Okay. Well, this was a little bit shorter because I wanted to see what people had questions, and I didn't do a poll this time just because I was like, it was more of a limited subject. So I'm actually finished ahead of time. That's unusual, as you guys know.
I have a question on something
Yeah.
else. You know how in Empower, can you see what percentage of your 401k is Roth versus
Yes,
traditional?
absolutely. So let me go back here. Go to are you're logged in right now, right?
Yeah.
Um,
I see something called account, and
click on it's right here where it says balance. It says view details. Click on that.
so I see balance, and then I see balance details, and there's lines that say employee pre-tax, which is probably the traditional, right?
Traditional. Yep.
And then employer match, which is probably traditional.
Yep, it is.
And then I see something called 401 rollover. So I don't know if that's traditional or the other one.
That's weird because you should have three different things. One being, did you roll money from another plan into this plan? Okay, so that's what that is. And if you have Roth dollars going in, it'll have another line that says Roth,
Okay,
the
so
Roth portion.
so
So
if there's no line, then there's no Roth.
then there's no Roth, correct? And so
There's a
all of
rollover.
that should add up to 100% though, right? Those numbers. Okay. So
And
I'm sorry, what was your last question? I was talking over
what
you
if
on this.
there's a rollover? Does that count as a Roth or a traditional?
It depends on what you rolled over.
Okay, so just
So it's because if it was all Roth at the time, then it's all Roth now. If it was all traditional or a mix, it stays in that same proportion.
Gotcha.
But and that's where you got to be smart. Like when you're down the road, if you're going to roll money into an IRA, which is what I'm down the road going to do, but you got to, every circumstance is different, because if you retire early, you can't use your IRA money, unless you have a good brokerage account. Where are you going to get money? But if you retire the year you turn 55, you can use that 401k money. And then what you could do, Wesley, like you did, if you didn't, say you started a company at age 54, you're not going to have much money in that 401k, right? But you could roll from another 401k that you had or TSP into that account, and then you retire at 55 or 56, up anytime from the year you turn 55, you can use all of that money in that 401k penalty free. And then it's whether it's traditional or Roth, that's all depends. But that's why, let's say you had a huge traditional 401k, you're not going to, if you roll that all into a Roth IRA, yep, it's going to become Roth, and you're going to pay taxes on all of that money at once. That's why you don't do that. You go roll the Roth into the Roth, roll the traditional into a traditional, and then you wisely do conversions, looking at what tax bracket you're okay with. You convert to a certain amount each year so that you get more Roth dollars in there, but you minimize your tax rate, your taxes. Make sense?
Yeah.
Okay. What are I had to bring up some questions for somebody else, I know.
Hey, Alan, I
Yeah.
wasn't clear about if it's better to have on your contribution. Is it better to have a higher percentage on your Roth and lower on your
Okay.
traditional?
Let's go here. Dustin, here's That's why I said get your tax return and look at line 15 here.
I got it.
Okay, and then what that number is, and then if you got to look at next year if you're going to have more income or less, and then here's our tax bracket. So where does that taxable line 15 fall into here? And then that helps you determine. Let's say, and that's why I said, like, hey, if you're, let's say, Dustin, let's say right here you were at like 205,000, so you're getting this, 205,000 minus 197, whatever, $7,700 taxed at 32%, not counting state. That's a significant jump, in my opinion, from 24%. So I would contribute. I'll figure out the percentage. Like, wait a second, I want $7,700 to go to traditional, so that I stay in the 24% tax bracket. Make sense? 22 to 24, to me, that's 2%. That's insignificant. And looking at historical tax rates, that's pretty damn low. You know what I mean? So, and nobody complained about tax-free money in retirement as well. But let's be smart about it. If you're in the highest tax bracket, okay, let's go traditional and then convert later when we have less income after we retire. The gap years, we call that, between when you stop getting, a salary income and you start taking Social Security and have to take RMDs, which for everybody here in this is probably, it'll be 73, is it? I want to say, or is it 75? It's the ages went up from 70 and a half. I think for us it'll be 70, 73 or 75. So those are the gap years when to do those conversions, when you're in a low tax bracket, if you don't have much income coming in, and you can pay taxes on that the pre-tax money, and then it grows tax-free forever once you convert. Okay.
Yep. Thanks.
Yep. What are the questions? We got a couple more minutes.
Yeah, quick one.
Yep.
So I actually have a 401k plan within Power from a previous employer.
Okay.
The yield is actually a little better than what I'm getting here, but do you recommend leaving it there or rolling that over into
Say that
type
again.
of-
One, and remember, I'm not making any recommendations or advice.
wrong word. Okay.
Okay.
If it were you, would you leave it, in
Wait, what is this
previous-
money that you're talking about? Is it Roth or traditional? And what did
It's a traditional.
it's a
401k.
traditional. Okay.
Yeah.
So when you're considering rolling stuff in, you got to look at both 401k plans and which one have the better investments and the lower, in general,
Exactly.
lower expense ratios. So if it's,
Yeah.
and if it's, but then it goes into that consideration of the rule of 55 as well. If you want to retire early and you don't have much in a brokerage account, so even if another company and that you worked at before has a better 401k, but you need that money to spend in retirement, it might be good to roll some of that into the plan, just so you have that penalty-free money.
Okay.
Make sense?
Yeah.
Okay. What other? Okay, and right, when selling for capital gains in order to rebuy at a higher price, do you need it to do it within 30 days? No. If you're doing capital gains harvesting, where you're selling stuff that you gained and then you can rebuy it the same day, you could essentially. Typically you won't be able to do that because it hasn't settled, and then you can rebuy. But you can. There's no. You've taken the gain. You've realized the gain, so you're paying tax on it, and it just depends on where you're at. If you're on sabbatical or don't have an income coming in, you can get away with paying 0% for a decent amount, which is freaking sweet. But then you rebuy it so that you have that higher cost basis because you don't need that money right now. Then down the road, years later, when you want to use it for what you want to use it for, you won't pay near as much in taxes because you already accounted for that huge gain. Losses, that's where you got to wait the 30 days if to buy in the same thing. But you can typically, like if you had the S&P 500, and it dropped, you could buy the total U.S. stock market because it's different indices. It's different enough, you know what I mean? So, but that's kind of, I guess, for another day. We can talk about it. Okay. Any other questions? Hey, Brittany, just so you can. Good to see you.
Actually, I got one more question for you, if you
Yep.
don't mind.
Absolutely.
So is it still for itemizing, if you buy a house, is it still the cap that you can use for the interest on the house as an itemized deduction, still 750? Is that still the cap?
Is it? Yeah, 750K is yes, is the current.
Okay, so then anything over that is that percentage that you pay on that interest, correct?
Yeah.
Okay.
And so, and you can't deduct that, unfortunately. You know, like, and that goes into this is now we're going definitely beyond the scope likely. But since we've changed all this stuff, and there's a huge, only 10% of people do itemized deductions anymore, and so, and that's where, but because of that, if you donate to charities or things like that, you have a donor advised fund. What you could do is in 1 year, take all of those things. Like, let's say you donate to charity, that's important to you. Well, but you don't typically itemize because the standard deduction's so large. Well, what you could do is front load a couple of years or multiple years of those donations. It's in 2025, take the itemized deduction. That's that charity money. You don't have to give it right away if it's in a donor advised fund. You can, hand it, offer it out down the road. But you can take that larger itemized deduction. Then the next year, I'll just take the standard deduction.
Yeah, because I think what I'm looking at now is that the SALT tax plus the interest, I'm looking at, I think it's like 50-something thousand in itemized deductions or something like that. So in that case, I would just take the itemized deductions, right?
Yep.
Yeah. Okay.
Yeah. So, and that's something though, like swapping, doing real tax planning like that, where some years you might use a standard deduction, some years the itemized deduction. It's a good tax strategy, especially for people that are charitable minded, because that if you donate all this stuff to charity, but then the standard deduction is still above that, you're like, what the, like, hey, you donated to charity, which is good, but you could have been smarter about it. If you put all these potentially tax deductions together in 1 year, and then you take a large itemized deduction, and then the next year is take standard.
Okay.
So, okay, any other questions?
I had one quick question.
Okay. Yeah.
When we were looking at the balances of like where everything was, we have the employee pre-tax and then like employer match. Those are considered traditional, correct?
They are. And okay, so real quick, so the Secure Act allowed companies to do a Roth match. We don't have that yet. And most companies don't. They had to change their plan to do that. But that's a capability that's allowed now. It used to be always, until I think 2024, it always had to be traditional, the match. But now companies have the ability, and you're going to pay, though, you have to pay those taxes for, if you want Roth dollars in the match, you'll pay those. But that's Roth money. So, and moving forward.
Okay.
Okay. What other questions? Okay, well, I think that's it. Sandra, are you going to the VBC tonight?
I'm gonna try to be there. Still trying to decide.
No, that's not good.
Yeah.
Hope to
Are
see
you gonna
there.
be there?
Yeah. Yep. I'm
Okay.
bringing an ice chest because there's you know, since it's at the Viper House, it's not it's unusual. So some of us are bringing some ice chests to
Yeah.
help assist. So
Yeah. No, hopefully I'll see you there. I'll try to make it.
cool. Hope to see you there. Okay. Well, thanks everyone. If you have any questions, let me know, and you can drop them in the Slack. If you put it in the Slack channel, tag me so that I see it, because I don't always just go, that highlights it to me that I've got a message to go read.
Where's the VBC at tonight?
It's at the Viper House, which is down in Point Loma, so it's pretty far south. But this is our 3rd year in a row that we're doing it at the Viper House. We're working with the Coast Guard. Actually, they're there. But it's totally cool. Viper House being Top Gun, right? You guys remember the first Top Gun?
Yeah.
Viper, when Maverick went over to Viper's house, that's where it's at. So it's really freaking cool. And there's a lighthouse there. You go up, it's just beautiful. So it's a cool one to go to if you.
What time is it tonight?
And you have to sign up.
Yeah, you have to register.
You have to register. So go to VBC Victor Bravo Charlie San Diego.org and RSVP. Go into the events link and then you RSVP, and because they'll check this one. It's limited capacity, and they're going to check the names, of each person. So, anything? Did I miss anything, Sandra? Yeah.
No, yeah, just as long as you register, and they probably still have spots available.
Yeah,
you can show up, and once you get to the gate might be closed, but you'll have to go around because it is like a national park.
Yeah, I know. I was trying to think. I'm like, how do I get there again? So cool. Okay. Well, thanks everyone. Have a great rest of the day. And if you have follow-up questions, let me know, because I know we kind of ended up hitting on some things we didn't have exactly on the agenda.
Thanks, Alan.
Cool.
Thanks, Alan.
Thank you. See you.
Thanks, Alan.